While everyone was watching XRP's price chart last week, a document quietly moved through the US Treasury that 99% of retail investors completely missed. And I'm not talking about a vague policy memo. I'm talking about a structural change to the legal definition of digital assets in wholesale banking, a change that removes the single biggest obstacle between Tier 1 banks and the XRP ledger. Most people in this space are still asking the wrong question. They're asking when the price moves. The institutions moved past that question months ago. They're already asking how much they need to hold before the float becomes unavailable. There's a number buried inside the global banking system right now, $27 trillion. And when you understand what it means for XRP, you will never look at the current price the same way again. Let me show you. Welcome back to Ledger.Wealth.Network, where we cut through the noise and follow the institutional signal, not the social media sentiment. I don't chase pumps. I don't call tops and bottoms. What I do is track the structural moves that happen before price reflects them. Today, we're pulling back the curtain on the Nostro Vostro problem and why solving it changes XRP's entire demand equation permanently. Here's what almost nobody in retail fully grasps, and it's not complex once you see it clearly. Right now, every international bank in the world is sitting on pre-funded accounts called Nostro and Vostro accounts. These are accounts banks hold in foreign currencies, in foreign banks, in foreign countries, so that when you wire money internationally, there's actually money on the other end ready to settle. The global total locked in these accounts, $27 trillion, sitting idle, earning nothing, just parked there to grease the pipes of the correspondent banking system. Think about what that number means. 27 trillion in capital that cannot be deployed. It can't be lent. It can't be invested. It just sits because the system requires it as collateral for a transaction model that was designed in the 1970s. This is the Nostro trap, and it is the single biggest inefficiency in global finance that nobody outside of institutional banking is talking about. Now, here's where XRP enters this equation in a way that most retail analysis completely misses. XRP's on-demand liquidity model, ODL, was designed from the ground up to replace pre-funded Nostro accounts. Instead of a bank parking $200 million in a foreign currency account for 6 months, they source liquidity through XRP in real time, settle the transaction in seconds, and that $200 million stays on their balance sheet earning yield. You see, retail investors are watching XRP like it's a speculative asset competing with other tokens. But what David Schwartz and the engineering team at Ripple actually built is a Nostro account replacement system. And the addressable market for that system isn't crypto's total market cap. It's $27 trillion in stranded capital. The question you should be asking isn't, can XRP reach $10? The question you should be asking is, what price does XRP need to reach before it can absorb even 3% of that $27 trillion in ODL volume without creating catastrophic slippage? That answer, as we're about to see, is not $2. Let me be precise here because the math is what separates this from speculation. Today, XRP's circulating supply sits at approximately 57 billion tokens, market cap at current prices, roughly 115 billion. Now let's run the Nostro scenario. If global banks were to use ODL to free up just 3% of those pre-funded Nostro positions, just 3%, we're talking about $810 billion in annual settlement volume flowing through the XRP ledger. At $2 per XRP, moving $810 billion requires 405 billion tokens annually. That is more XRP than exists in total circulating supply, multiple times over. The slippage would make the entire system non-functional. Spreads would blow out. Transactions would fail. The math breaks. Now let's run it at $50 per XRP. That same $810 billion in volume requires 16.2 billion tokens. Manageable with existing supply, but still volatile at scale for daily institutional throughput. At $500 per XRP, 1.62 billion tokens to settle $810 billion in annual ODL volume. That's within an operationally efficient range for institutional use at scale. This isn't a Moonboy price target. This isn't technical analysis. This is the engineering requirement for the system Ripple is building to actually function at global banking scale. Think about that math differently. Fixed supply, 100 billion total, board 57 billion circulating. Ripple's escrow continues releasing 1 billion monthly, but on-chain data from CryptoQuant consistently shows the majority is immediately relocked rather than hitting exchanges. The liquid, tradable float is already a fraction of the headline number. Once institutional ODL channels begin absorbing supply into liquidity pools and custody arrangements, that float doesn't come back to retail markets. It gets locked into the infrastructure permanently. And here's the part that should make every holder pause. At the current price of roughly $2, there are still retail investors debating whether XRP is real. Meanwhile, on-chain forensic data is showing exchange reserves trending toward multi-year lows. That is not what distribution looks like. That is what quiet, systematic accumulation looks like. From entities that are not posting about it on social media. The math doesn't lie, and the math is pointing in one direction. So who are these entities? Let me give you the names the mainstream financial press is barely covering. Franklin Templeton, one of the oldest and most conservative asset managers in American history, has now tokenized its money market fund on multiple blockchains, with the XRP ledger included as a settlement layer. This is not a pilot program. This is a live product serving institutional clients. Ask yourself this brutal question. Does a 75-year-old asset management firm with $1.5 trillion under management move onto a new settlement layer without months of internal legal review, compliance sign-off, and executive approval? Absolutely not. They don't experiment, they position. Then there's the Swift integration layer. Ripple is now a certified Swift partner, meaning the messaging infrastructure that connects over 11,000 financial institutions globally is now capable of routing directly to the XRP ledger for settlement. That integration doesn't exist for speculation. It exists because correspondent banks need a viable alternative to the Nostro system. And then there's the signal from Japan. The Japan Financial Services Agency, the FSA, has moved to formally classify XRP as a non-security payment asset under Japanese financial law. Japan, one of the 3 largest foreign exchange markets in the world, just gave XRP the clearest regulatory status of any major jurisdiction. Why does that matter? Because Japanese banks, SBI Remit, Sony Bank, MUFG, are not ideological about crypto. They move based on regulatory certainty. And they just got it. While retail investors are watching XRP's daily candles and calculating whether to take profits at 220, institutional players in 3 continents are quietly building the infrastructure that makes this price look like a rounding error in retrospect. The signal is clear, but only for those who are actually looking at the institutional layer, not the price chart. Let me be specific about what happens next, because timing is where most retail analysis falls apart. There are 3 gates moving simultaneously right now, and when they converge, the supply picture changes in a way that doesn't reverse. Gate 1, the U.S. Digital Asset Clarity Act is currently in markup. The House Financial Services Committee has signaled a floor vote before the end of Q2 2026. The moment that bill passes, the legal ambiguity that has kept institutional custodians on the sidelines evaporates. Custodians at Fidelity, Schwab, and BNY Mellon have already built the infrastructure. They are waiting for the legal green light, not the technical one. Gate 2, Ripple's National Trust Bank Charter. Preliminary conditional approval is in place. Full activation converts Ripple from a fintech operating in a gray zone into a federally regulated financial institution, and that status change is what opens the direct institutional pipeline to the XRP ledger for banks that currently cannot touch it for compliance reasons. Gate 3, XRP Spot ETF approval. With Bitcoin and Ethereum ETFs now fully operational and pulling institutional capital, the XRP application pipeline is next. The structural precedent is set. The product category is approved. The clock is running. These 3 gates are not sequential. They are converging. And the historical pattern is consistent. When regulatory gates open on an asset with genuine institutional infrastructure behind it, the retail window for positioning doesn't stay open long. The window is closing, not someday. This quarter. Here is the mechanical reality that most XRP holders haven't fully internalized. Every institutional ODL channel that goes live requires XRP to be held in reserve, not traded, not sold, not available on exchanges. Every liquidity pool deployed on the XRP ledger absorbs tokens from the tradable float. Every corporate treasury that integrates on-demand liquidity reduces the supply available to the next buyer. This isn't a supply shock that you'll see announced on a news headline. It's a slow structural drain that happens quietly, contract by contract, integration by integration, until one day the ask side of the order book looks very different than it does today. The float contraction isn't coming, it's already underway. Exchange reserve data confirms it, on-chain flows confirm it, institutional filings confirm it. The only thing that hasn't confirmed it yet is the price. And historically, price is always the last thing to reflect what the data already shows. I know what some of you are feeling right now. You've heard versions of this story before. The banks are coming, regulation is close, price is about to move. And every time, the timeline stretches and the frustration compounds until holding feels indistinguishable from being wrong. Let me address that directly. The frustration you're feeling is not a signal that the thesis is broken. It's a signal that you're in the compression phase, the period that always precedes a structural repricing event. Multi-month price compression combined with declining exchange reserves and rising institutional inflows is not a pattern that precedes further decline. It's a pattern that precedes acceleration. The retail investors who benefit from what's coming are not the ones who time the exact entry. They're the ones who understood the Nostro problem before it was solved, who understood functional pricing before institutions priced it in, who held through the compression phase when doubt felt like wisdom and patience felt like passivity. You came to this video because something wasn't adding up, because $27 trillion sitting idle in pre-funded banking accounts, solvable by a technology that's already live, didn't match a $2 price tag. That intuition is correct. Understanding why it's correct, the supply mechanics, the ODL math, the regulatory timeline, is what separates the people who hold through the event from the people who sell into it. The Nostro trap has been the invisible ceiling on global banking efficiency for 50 years. The math is clear. The institutional moves are documented. The regulatory gates are in motion. And the asset designed to unlock $27 trillion in stranded capital is currently priced at $2. That is either the most irrational pricing in financial history or the greatest accumulation opportunity retail will ever have access to before the infrastructure goes live. The institutions already know which one it is. The question is whether you do. If this kind of structural analysis is what you come here for, not hype, not price predictions, not noise, hit subscribe and turn on notifications. Because the next video covers what happens to XRP's supply mechanics after the ETF approval lands, and why the 12 months following that event will look nothing like the 12 months before it. Comment Nostro below if you made it to the end. I want to see who's actually paying attention. Stay rational, stay positioned.